Welcome to The Explainer. Today, we're taking a look at what might honestly be the single most aggressive corporate finance experiment in modern history. For years, MicroStrategy has been famous across the entire financial world for one massive, totally uncompromising bet. But recently, something almost unthinkable happened. We're going to dive straight into MicroStrategy's unprecedented pivot from simply hoarding Bitcoin in a digital vault to actively managing a highly complex, deeply leveraged financial machine. It's a wild story about how a traditional software company transformed itself into something entirely new, and trust me, the sheer scale of this experiment absolutely demands our full attention.
To really grasp the magnitude of this shift, we kind of have to look at the foundation first. For years, MicroStrategy's whole corporate identity was built on one unyielding philosophy: never sell. Buy Bitcoin, hold Bitcoin, and buy more Bitcoin. It wasn't just a financial strategy. Honestly, in the crypto space, it was treated like an absolute religion. And this relentless approach, it resulted in a staggering peak treasury of nearly 847,000 Bitcoin by June 2026. To put that into perspective, they had spent roughly $63.94 billion to acquire that reserve. That single number, 846,842, became the ultimate symbol of their corporate strategy, a real testament to their diamond-handed approach to the market.
But then, a glitch appeared in the machine. The company actually began selling. Yeah, you heard that right. In July 2026, they sold roughly 3,588 Bitcoin. Then, they offloaded thousands more through early August, effectively dropping those legendary reserves down to 840,447 Bitcoin. For the first time in years, the unwavering accumulation phase effectively paused. The massive hoard actually began to shrink.
So, this unprecedented drop forces us to ask a really critical question. Why on earth is the Bitcoin machine selling the very asset that entirely defines its modern corporate identity? I mean, if the mandate from the very top was literally never sell, what exactly changed behind the scenes to force their hand? Part 1, the corporate Bitcoin machine. To really understand this major paradigm shift, we first need to break down how MicroStrategy's financial engine actually operates. Because this isn't your ordinary software company anymore, and it's definitely not a traditional investment fund. You see, the core strategy isn't just buying crypto with spare cash. It's actually a highly engineered, cyclical feedback loop. Let's walk through the gears of this machine. Step 1, you raise capital using equity, debt, or preferred securities. Step 2, you take that massive influx of cash and buy Bitcoin. Step 3, ensure that move expands the shareholders' actual exposure to that Bitcoin. And Step 4, repeat the whole process. Keeping this cycle spinning is absolutely vital to their existence. As long as the capital markets are open and willing to lend them money or buy their stock, the machine just keeps spinning, pulling in cash and spitting out Bitcoin accumulation at a massive scale.
But there's a catch. The absolutely crucial point to understand is the concept of Bitcoin per share. Total accumulation means absolutely nothing if the company is issuing so many new shares that the dilution outpaces the crypto being bought. Think of it like slicing a pizza, right? Getting a larger pizza doesn't really help you if you're slicing it into 100 tiny pieces. So the fundamental question isn't just how much Bitcoin MicroStrategy owns, it's how much Bitcoin each shareholder ultimately has economic exposure to. The numerator matters, sure, but the denominator matters just as much if you want to understand the true value being created for the investor. To track this delicate balance between accumulation and dilution, the company uses a specific performance metric called BTC Yield. Earlier in 2026, they proudly reported a year-to-date BTC Yield of 13.3%. Now, if you're an investor, it is really important to clarify that this is a growth metric based on their assumed diluted share count. It is not a traditional paid dividend. You are not getting a 13.3% check in the mail. It's simply their internal way of measuring whether this massive capital management strategy is successfully increasing that vital Bitcoin exposure per share over time. Which brings us to part 2, the weight of debt. Because, accumulating tens of billions of dollars in Bitcoin using the capital markets creates an enormous, somewhat hidden weight. This machine needs constant financing to run, and that financing creates massive financial obligations.
Remember those recent surprising Bitcoin sales we talked about earlier? Well, including a massive $108.6 million transaction on August 10th, those weren't just a sudden change of heart about the asset. They were executed to help build a US dollar reserve of roughly $4.65 billion. Why do they need so much cash? Well, because you simply cannot pay traditional Wall Street debts with a locked-up digital asset. You need cold, hard cash. MicroStrategy isn't cashing out of fear. They are actively managing their required liquidity. The Bitcoin goes out, the cash comes in, and that cash is strictly used to support their highly leveraged balance sheet.
And they desperately need that liquidity because their obligations are honestly staggering. As of their May 2026 update, the company is carrying approximately $6.7 billion in aggregate principal amount of outstanding convertible notes. In simple terms, convertible notes are just a type of debt that can eventually be turned into company stock. Now, that is a massive amount of borrowed money that helped build their famous Bitcoin treasury, but it isn't free money. It absolutely must be serviced, managed, and eventually settled.
And the financial obligations certainly don't stop there. On top of that convertible debt, the machine is weighed down by roughly $15.5 billion in preferred stock obligations. Essentially, these are structured promises to pay out dividends and returns to specific high-tier investors. So holding that multi-billion-dollar liquidity reserve we just talked about, it isn't some corporate luxury. It's a structural necessity to keep the entire operation from buckling under its own weight.
The sheer risk of operating with this much leverage was violently exposed in Q2 of 2026. When Bitcoin's inevitable downward volatility struck the market, it triggered an $8.32 billion unrealized fair value accounting loss for the company. Now, in plain English, this is what you call a massive paper loss. While $8 billion in cash didn't physically fly out the door, it proves a terrifying reality. A simple, temporary price swing in the Bitcoin market can completely dominate the company's financial statements to the tune of billions of dollars in a single quarter. And this brilliantly illustrates our absolute most crucial point for anyone watching this explainer. Owning MicroStrategy stock is simply not the same as holding Bitcoin. Think about it. If you buy Bitcoin directly on an exchange, you just own the digital asset. It sits in your wallet. But if you buy MicroStrategy stock, you're buying into a highly leveraged corporate entity. You get the Bitcoin, yes, but you also get the debt, you get the preferred stock obligations, the capital market risks, and the operating software business. Leverage works in both directions, amplifying the gains during a bull run, but drastically compounding the risks during a downturn.
Part 3, the premium feedback loop. So, what actually keeps this whole thing going? Well, it comes down to a bit of capital market magic, known as the MSTR premium. Basically, this is the valuation that the stock market arbitrarily places on the company above and beyond the actual underlying Bitcoin it holds in its treasury.
When the stock trades at a high premium, the strategy acts as this beautifully efficient engine, but really only when the sun is shining on the crypto market. The company can issue new common shares at incredibly attractive premium prices, like a recent $653.1 million stock sale they executed, and then use that freshly raised capital to buy even more Bitcoin. It's a perfect feedback loop. A high premium leads to highly profitable equity issuance, which brings in a flood of capital, which buys more Bitcoin, which ultimately increases the overall exposure for the shareholders.
But, as you might guess, this loop is incredibly sensitive to broader market conditions. In the bull case, Bitcoin rises, the premium is maintained or even grows, capital is easy to raise, and the cycle seamlessly reinforces itself. But consider the bear case. If Bitcoin falls, the premium can completely disappear or worse, turn into a discount. This specific relationship is tracked by a metric called MNAV, market to net asset value, which directly compares their stock price to the actual value of the assets they hold. When that MNAV drops into a discount, issuing equity to raise cash becomes incredibly expensive and difficult. Suddenly, to pay those massive Wall Street obligations we talked about, the company is forced to do the unthinkable, tap into their vault and sell their Bitcoin treasury.
And this fundamental structural vulnerability explains the biggest strategic change in the company's entire history. The never sell era is officially dead. This is a massive corporate culture shift, guys. They are officially shifting from a rigid, diamond-handed mentality to actively using Bitcoin as a working liquidity resource. In 2026, they established a brand new capital framework specifically allowing these strategic sales to support their day-to-day liquidity needs. The vault is no longer just a vault, it has become an active financial resource.
Part 4, surviving the next crash. So, with billions in debt, a shifting market premium, and a newly activated capacity to sell off their core asset, how do we evaluate what happens to this machine next? Just how big can this strategy actually get before it breaks?
If you want to track the true health of this company going forward, you have to look right past the standard daily stock chart. You must relentlessly monitor 5 crucial indicators of capital stability. 1. Total Bitcoin holdings. Are they aggressively buying, or are they continuing to quietly sell? 2. BTC per share. Are the shareholders actually getting real exposure, or are they just being diluted? 3. USD reserve health.
Is their cash liquidity growing, or is it draining away? 4. Capital structure obligations. Is that massive mountain of debt still manageable? And 5. M&AV. Does the market still grant them that all-important premium to keep the engine running?
Because ultimately, the true test of MicroStrategy isn't how much Bitcoin they can vacuum up during a booming, euphoric bull market. Honestly, any company with open access to capital markets can do that. The real question is this: can this complex, leveraged, heavily indebted engine withstand the next major, sustained market downturn? When the premium vanishes and the massive obligations finally come due, will the Bitcoin machine survive, or will it be forced to consume itself? The ultimate stress test hasn't happened yet, but the clock on this multi-billion-dollar experiment is officially ticking.